Hello, my name is Corey Kahn, Dr. Corey Kahn. I'll be your instructor this term for ECO 610, Fiscal and Monetary Policies here at SNHU. I wanted to take just a minute to introduce not only myself, but the content of the course and what we'll be looking at for the next 10 weeks. First off, most of you will be familiar with fiscal and monetary policy, having studied economics to some extent prior to entering this program that you're involved in right now. However, for those who aren't familiar with fiscal and monetary policy, fiscal policy is simply the government's attempts to affect the economy, employment, output, inflation, things like this, through its powers of taxing and spending, or taxation and spending. Monetary policy, on the other hand, is the government's attempts to control the money supply, interest rates, and financial markets, and through these control or affect the broader economy. So that's the overall content that we'll be looking at, but you'll notice immediately that the name of the textbook, once you log into the course, is Money and Banking. That should give you some idea of the emphasis within macroeconomics that's grown up within the past 10 years or so. The period from roughly the mid-1980s to 2007 was a period of great macroeconomic stability. And during that time period, the United States went through only 2 mild recessions, and unemployment never grew or reached above 8%. This was called the Great Moderation, and there were 3 leading explanations for this Great Moderation. And those explanations were basically luck, changes in the structure of the economy, moving more from a manufacturing-based economy to a service-based economy, or 3, improved policy. And it was really improved policy which gained the spotlight. And that improved policy focused on monetary versus fiscal policy. For many reasons, we'll get into some of those as we move through the course, but monetary policy has taken on a much more important role in economics since the 1980s. And this was very much the case, or monetary policy took on an even greater importance after the financial and macroeconomic crisis of 2007. During that period, a number of major investment banks collapsed, stock prices fell more than 25% in 4 weeks, and GDP suffered the largest decline that it had historically since 1957-58. So we'd had a long period of prosperity followed by a profound financial collapse. And given that that financial collapse began in financial markets, lending institutions, things like this, monetary policy, in fact, took a lead role in curing that macroeconomic disturbance, or bringing us out of that disturbance. However, it was during that period that we found out that conventional monetary policy was ineffective in some circumstances. And during this period, what's called the zero lower bound took on great importance. That's the point at which the central bank can no longer lower the interest rate to stimulate investment and increase economic activity. In a sense, at that point, at the zero lower bound, the hands of banking authorities, the Federal Reserve monetary authorities, the hands of those entities are tied, and monetary policy becomes ineffective in its traditional guise, which was control of the money supply to influence interest rates and things like this. So, at that point in time, monetary policy started to evolve and a number of unconventional tools were adopted. As that will be, those tools will be a great part of the emphasis that we'll be looking at throughout this course. We'll also be looking at the effect that the financial collapse had on consumer expectations and the way those are transmitted to the broader economy. We will start off by looking at money and money markets, financial instruments, more complex financial instruments, monetary policy, how monetary policy affects the broader economy, the system of central banking here and in Europe, so that we get a complete picture of how monetary policy is how it functions. We'll look at financial intermediaries that had a great role in this financial collapse. Then we'll look more at ongoing policy, future policy, and risk mitigation. That brings me to your project, the series of milestones which you'll complete throughout this course. As managers and executives in any kind of business entity, you're often called upon to interpret data and to draw research-based conclusions to make financial decisions regarding the firms you manage. To that end, you have to understand economy-wide or macroeconomic fluctuations and how these affect the firms that you manage. So for your project or that series of milestones for this semester, you'll be asked to identify a macroeconomic risk which will affect a firm or a region, and you'll be asked to identify variables associated with that risk. Then in the middle segment of that milestone, you'll be asked to gather data and given patterns that you see in that data, you'll be asked to forecast the direction of major variables. Given that, you'll identify a risk posed to a firm or an industry. It's actually more of an industry that we're thinking about. And so then in the final part of your milestones, you'll have to develop a risk mitigation plan for that milestone or for that industry. One thing that I'd like to just point out is that you're going to be choosing a country of interest, and your primary concern will be whether you can gather economic data, macroeconomic data on inflation, employment, things like this, for that country of focus. So if you choose a country like Vietnam or Malaysia or Oman or wherever else, just be sure that you can gather data sets of a long enough time period and that you have access to the data to support those milestones. That will be your biggest challenge. With that being said, or with all of this being said, I hope you enjoyed the course. It's an exciting course. It addresses many things that are important politically and in our situation, our economic situation and financial situation as it's evolving. So I look forward to being with you this term, and please, I want you to know that any of you can contact me at any point. I'm here to assist you, to support you, to answer your questions, and I look forward to meeting you all, and I thank you very much for taking the time to be with me.